U.S. CPI preview. What does it mean for Fed rate cuts? The upcoming U.S. inflation report could determine whether the Federal Reserve begins cutting rates in December, with markets keenly watching for signs of continued disinflation. The U.S. Consumer Price Index is set to rise 2.7% YoY in November. The core CPI inflation is seen steady at 3.3% last month. The Fed is expected to cut interest rates by 25 bits per second in December. The U.S. Consumer Price Index (CPI) report for November, a key measure of inflation, will be unveiled on Wednesday at 13:30 Greenwich Mean Time by the Bureau of Labor Statistics (BLS). Markets are buzzing in anticipation, as the release could trigger significant swings in the U.S. dollar (USD) and influence the Federal Reserve's (Fed) plans for interest rates in the months ahead. What to expect from the U.S. CPI report? Economists forecast core inflation, which excludes food and energy prices, to remain steady at 3.3% year-over-year, YoY, for November. The monthly Core Consumer Price Index, CPI, reading is expected to show a 0.3% increase, a level consistent with the Federal Reserve's, Fed, disinflationary narrative. Headline inflation is predicted to demonstrate further moderation, supported by easing energy prices and broader price pressures. Market participants using Forex trading platforms are closely monitoring this release for its potential impact on U.S. dollar movements. Key components under scrutiny. Shelter costs remain a critical focus, as housing-related expenses have been a significant driver of core inflation throughout 2023. Services inflation persistence continues to concern policymakers, with wage pressures potentially keeping prices elevated in this sector. Energy prices, though excluded from core calculations, will influence headline inflation and consumer sentiment. These components will be crucial for traders using CFD trading to position themselves. Market implications of the CPI data. An inflation print in line with or below expectations could cement market expectations for a December rate cut, potentially weakening the dollar. Trading platforms are likely to see increased activity as investors react to the data across multiple asset classes. Bond markets will be particularly sensitive to any surprise in the core inflation reading, affecting yields across the curve. Equity markets could rally if the data supports the narrative of controlled inflation and potential monetary easing. Impact on Federal Reserve policy. Markets currently price an 85% probability of a quarter-point rate cut in December, highlighting the importance of this inflation report. Traders engaging in online trading should consider how the data might influence the Fed's forward guidance. A higher-than-expected reading could challenge the market's dovish expectations and potentially delay rate cuts into 2024. The Fed's reaction to this data will be crucial for trading signals and market direction. How to trade the U.S. CPI release. 1. Research market reactions to previous CPI releases. 2. Open a CFD account with us to access U.S. markets. 3. Consider practicing your strategy with a demo account. 4. Monitor the CPI release and place your trades accordingly. Looking ahead to 2024. Markets anticipate up to 3 additional rate cuts in 2024 if inflation continues its downward trajectory. Economic indicators between CPI releases will remain crucial for shaping policy expectations. The Fed's response to evolving inflation data will guide market sentiment throughout the year. Traders should maintain flexibility in their strategies as the inflation narrative continues to develop. What does the Federal Reserve do? How does it impact the U.S. dollar? Monetary policy in the U.S. is shaped by the Federal Reserve, Fed. The Fed has 2 mandates: to achieve price stability and foster full employment. Its primary tool to achieve these goals is by adjusting interest rates. When prices are rising too quickly and inflation is above the Fed's 2% target, it raises interest rates, increasing borrowing costs throughout the economy. This results in a stronger U.S. dollar, USD, as it makes the U.S. a more attractive place for international investors to park their money. When inflation falls below 2% or the unemployment rate is too high, the Fed may lower interest rates to encourage borrowing, which weighs on the greenback.
Friends, Thanks for watching. Please subscribe my channel for more videos.